so it's overrun with triple B credit. Some of these popular exchange-traded funds that focus really on investment-grade bonds may be riskier than they appear. Here to discuss all of this is James Seyffart from Bloomberg Intelligence. So talk to us about what's going on with investment-grade debt and how that's affecting ETFs.
Yeah, so if we take an example of iShares' LQD, which is their investment-grade corporate bond ETF, it's the largest, most liquid, sits at $34 billion in AUM. You're looking at the historical allocations to triple B and all the other allocations of ratings, and triple B has gone up a lot. So in 2010, it was around 28%. Now it's over 44%. So it's no surprise that corporations are issuing a lot of debt, low interest rate environment. So this has caused a lot of issuance of triple B, which again is the lowest rating in the investment grade tier. Is this a bad thing? Not necessarily, but it's something that investors should be aware of, that they might not just know that's going on.
Well, and it's all about the risk return profile, I'm sure, as you know. So what are some of your options if you're getting a little bit nervous about the triple B sector, want to move up in quality? What are some of the options to reduce your exposure to this?
Yeah, so in the ETF universe, there's not many options. There's only really one, and it's another iShares product, QLTA. So this product avoids exposure to triple B. So it only invests in the single A to triple A market. The issue here is that triple B, as we stated, makes up a huge chunk. It makes up 46% of the investment-grade bond universe, and it has accounted for over 50% of the return in recent years. So you're giving up yield and return by going to the single A and triple A, and QLTA has underperformed LQD by over 5% since its inception. So you're giving up some of that yield and return, but for somebody who really wants the high-quality stuff and wants to avoid some of the lower-quality IG, this is probably your best bet. Okay,
but you are giving up some return because, as you've said, some of those triple B credits have been some of the best performers over the last 5 years or so.
Yes, definitely. In the investment grade market, that's correct. So one other way to play this, if you don't want to give up that yield and return, is to invest in an actively managed fixed income ETF.
Okay.
So we have a bunch of actively managed corporate bond ETFs on the terminal and in the universe for U.S. exchanges. Now, these ETFs are going to be better. They'll have high exposure to triple B, but theoretically, these managers have access to an army of credit analysts, right, that are going through, picking out the bonds that are going to be the most attractive, avoiding the least attractive, and avoiding that issue that you might see with the triple B market.
So if I'm really still interested in that triple B market, I'm not too concerned yet about where we are in the credit cycle. What are some of the specific ETFs that I can use to really get some of exposure to those lower quality bonds?
Yeah, so actually, there's no specific triple B investment grade bond ETF. It's just not out there. So to look at one that would be the best exposure would be to see who has the highest allocation to triple Bs. And in this case, it's another iShares ETF, an enhanced yield fixed income ETF, IGEB. IGEB has over 80% of its exposure to triple B. So this is going to be your best bet. Its returns so far have been somewhere between high yield and investment grade, which is what you'd expect for something in the triple B market. It kind of sits right in the middle there. And yeah.
So talk to me quickly, because you also have a bond or an ETF that's called the Fallen Angel, which is sort of coinily named for that. And that really goes into the really high yield. You're looking at the triple C sector. What are some of these Fallen Angel ETFs?
Yeah, so Fallen Angel bonds are actually bonds that have been downgraded from investment grade to high yield. So that's from triple B down to double B. Now, what happens here is a lot of institutions, pensions, funds can only invest in investment grade. So once they get downgraded to high yield, they have to dump them, right? So sometimes they could be being sold below their perceived value simply because they're mandated to hold something that has investment grade quality. Now, performance-wise, these things have trounced high yield and investment grade together. So they have significantly outperformed over the past 5 years.